everyone, and this is the Business of Property on the Property Development Australia Facebook page. Thank you everyone for being here, and we have Justin Maddock from Gil McKerrow talking about a very, very sexy subject in property development, which is tax and tax accounting, and in particular tax structures. Welcome, Justin. I'd like to give a little bit of a brief about Justin. Whereas he is known as the Yoda and Gil McKerrow. And why is that? I think that's a great title to have.
Yeah, definitely. And thanks for having me on, Cheryl.
Not a problem.
It come about basically because if any of the staff have any problems, questions, they sort of come to me, and I seem to be able to answer everything. Even just standing beside them seems to have fixed the problem.
Okay, great. You've got special powers. So you definitely have special powers, definitely, because they're saying you have this ability to stay cool under pressure, which we can imagine when you've got tax challenges, the rest of society tends to go to, poop, whereas you're able to go, this is a great challenge.
Love a good challenge.
Share with the rest of the audience. So we've had a lot of people really interested in this, and I see it quite often in the group. We've got close to 4,500, whether it's developers, investors, but a lot of questions I see pop up about tax and structuring and all that. So give us a little bit of background about what you do and what Gil McKerrow does.
Yep. Yeah, great. So I've had a really great opportunity throughout my career to work with the top 4 developers in Queensland. It's my pleasure to be able to share what I've learnt over the years with the group tonight.
Fabulous.
Basically there are, we like to think tax is sexy, but
it can.
Not many people do. So
that's why we need to find the right person to take that on. So that's fantastic. I have a few questions for you. So we will have to test the Yoda-ness.
Yes.
When I would definitely, as always, welcome comments and questions from the rest of the group as well. We have quite a few people that have started to join us. Thanks, Ursula. Thanks for joining us, Peter, and a few others as well, but I can't see because I've got a delayed stream. But please do type in your comments, and when we have a bit of a breather between Justin speaking, I will definitely read them out as well. So let's start off with the basics. Why is tax structuring so important in property development?
It's not just the tax structuring, it's also your overall structure for your property portfolio that's important as well. And what we highly recommend is that before you commence on a project, that you really sit down and strategically plan what you want to achieve out of the development that you're working on. Because really that will then help us assess what your goals are, what you want to achieve, and then we'll typically ask some questions around what your intentions are for the project. Does the structure that we're recommending achieve your level of asset protection? Because asset protection is a mix between risk and cost. We need to find out, are there external parties involved? And then have you sat down and discuss with them what their expectations are, and then also have you documented it.
Okay.
And then finally, tax is the last thing that we talk about.
Right.
Because we feel that the other business considerations are more important than the tax outcome.
Okay. So you're talking about the legal structures as well as the tax structures there.
Yeah. So the legal structures have a big impact on what the tax outcome will be.
Okay. And so when you talk about intention, is that in relation to whether people are looking to sell or looking to hold? Are those sort of the main considerations in that aspect?
Yes. Yeah. So in tax, your original intentions when you go into the development are very important. And what we're looking at there is whether you intend to develop and sell, which would make the profits just taxed as normal income. And conversely, if you have to make a loss on the development, then that can also be offset if you're structured correctly against your other income as well.
Okay. And when we're talking about income, that's another thing where I guess we've got to work out from that aspect whether you're buying or developing as a company or in your own name.
Yeah, well, the structure will determine where you put your investment, and your intentions help frame that.
Okay.
If you're planning to build and hold for rent, then there are some considerable, the 50% capital gains tax discount. So there are specific structures we want to put in place to make sure that you maximise your chances of getting that. That's a fairly hefty tax saving.
Yeah, sure. So, we'll probably have a lot of developers that have structures as company or unit trust. Is there any time that there's a benefit to have it in a personal name?
I would say no. Probably the main consideration there is asset protection. Yeah. So if anything goes wrong in the development, you just have to Google horror stories with property. There's apartment fires in London, and there's the towers in Sydney that can't be occupied. Yeah. So developers face considerable risk. If you're doing the development in your own name, you're personally held accountable for that risk. Yes. So that means your car, your boat, your house, your lifestyle assets, they're potentially all at risk if anything does go wrong in the project. Okay. Strongly recommend that you don't undertake a development project.
Yeah, all right. So we know that means no personal name. That's definitely get some advice around that. So then there's the consideration, well, do I have it under a company or is it under a company, is it a trust structure? What are the differences there, I guess?
Yep. Yeah, so if we start with a company, some of the benefits there are you get the fixed company rate. So if you're doing repetitive developments, the company can be quite good to smooth out your profits, because development profits can be quite lumpy. So with our personal marginal tax rate system, if you have a high income level in one year and low in the next, you're going to be penalised under our tax system for that. So we try and smooth out your income, and the company structure is very useful in doing that. Okay. Yep. Company also gives you great protection. It separates the project from your personal assets, and in a company, the directors are the one at risk. So long as they're doing what they should, paying their taxes, paying their bills on time, they're at sort of a reasonably low risk, because the company is the one that can be sued if anything does go wrong. Just if you are using a company, you do need to be aware that if you do take money out for investments or for personal purposes, there are restrictions on that, and there can be a tax consequence. So they are a little bit fiddly to manage, and that's where that strategic tax advice is really beneficial to help you manage that each year.
Okay, and so that's so company structure is good if you're looking to take on numerous projects.
Yep. Numerous projects. You can structure it as a holding company style, where you have a company owning another company, and that way you can do the development in what's called the subsidiary company. When that's done and dusted, pay out all the profits, close it down, start a new company, and that really helps move the assets into that holding company structure to reduce your risk there. But just bear in mind, if you're doing a development in a company, and if you end up having to hold an asset for long-term rental, which potentially means it's going to be taxed as a capital gain, the companies don't get the 50% general discount. So they pay a higher rate of capital gains tax.
Oh, right. Okay. So definitely got to look into that and be mindful.
Yes.
And so when you talk about having sort of the holding company and then the subsidiaries, are you talking about what they call special purpose vehicles?
Yeah. Yeah. So they're setting up a company for a specific project.
Mhm.
When it's finished, pay all the profits, you can close it down.
Yeah.
And then it just makes it makes any profits more protected and harder to get out.
Okay.
Property lasts many years, so your risks are long. Something
Sure.
can happen 10, 20 years down the track, and if it can be traced back to a fault of the developer,
Yes.
there's some potential risks there. So it's good to close them off when the projects are finished.
Yeah. Understood. So we've got company structures, personal name, preferably a no.
Yep.
Are there any other structures we could be looking at?
Yeah. So trusts are probably the next, or one of the most common structures we see, particularly your discretionary and sort of your family trust structure. Really great for tax flexibility, because any income or profits, capital gains can be allocated across your family. So once children are over 18, if they're at uni, not earning income, there's some great tax benefits in using a trust there. If you put a trustee company in place, you get all the benefits of the asset protection that the company provides. But you do need to be aware of stamp duty and land tax implications, particularly in New South Wales and Victoria.
Okay.
We've got some recent changes around the foreign acquirers' rates of tax. And if your trust deed isn't worded correctly, a lot of people can be facing double rates of stamp duty.
Yes.
Yeah.
Okay, so definitely, if you have any partners that are investors that are from overseas, that we should be aware of that. Okay.
Yeah, that's right. And if you're looking to have external investors coming in, then the discretionary trusts, they're not really appropriate because of that flexibility. If you're coming in as an investor, you want that security that you're going to get your share of the profits. And that's where we could typically look at a unit trust structure that still gets the same tax benefits of the trust. You get your access to your capital gains concessions, but it gives that fixed entitlements to the income and capital profits, so that external investors know that if they invest 20% in the project, they're going to share in 20% of the profits.
Yeah, right. Okay. I have a question from David Ung here, and he's asking about cooperative trustee. I'm not familiar with that. What's a cooperative trustee, and what are the benefits? Are you familiar with that?
I've heard of a co-op, more for farming practices, more so than a development. No, I haven't heard of that cooperative trustee term, apart from corporate trustee, maybe. And that's basically where you have the company act as the trustee, and in a trust, the trustee is the one that is responsible for making the decisions. So it's the at-risk party. So by having a company as a trustee, you're limiting your personal exposure to risk. And so in a property development structure, that will be what we would generally recommend if you're going down the trust path.
Yeah, I have a feeling, particularly I have a certain level of knowledge about what David is doing in terms of building community homes. I wouldn't be surprised if he is referring to that co-op trustee, if there is something of that nature. That will be, maybe David, have a chat to Justin after the live to determine what you're looking to achieve there, because it sounds like that's something quite specialized.
Yeah, that's right. And that might be something that there's some not-for-profit specific rules around. Yeah,
I suspect that's the case. Excellent. No worries. Thanks for asking, David. So in terms of structures, we'll keep continuing with the structure questions. We often have joint venture partnerships.
Yep.
In the development space. What are the considerations there, and are there specific structures that, work better than others?
Yep. Yeah, definitely. So I think one of the things to be mindful of there is that joint ventures and partnerships are actually quite different to each other. So if we start with a partnership, that's where two people are going into the development together. What you need to be mindful of in partnerships is what's called joint and several liability. And that basically means that the actions of one partner can bind the other partner. So say, Cheryl and I, if we went into partnership, you pay your half share of the stamp duty, I decide not to, you can be held, or you will be required to pay the balance of the stamp.
I know where to find you, Justin.
Yeah, you do.
It's on your shirt.
Yeah.
Okay.
And partnership agreements, you can set up what each partner's roles and responsibilities are.
Okay.
But if one partner does the wrong thing, then your action, you can sue the other partner to recover from it. But the various state stamps officers are going to come after the person who's got the most money. So partnerships, be very careful of those. And partnerships also file a joint tax return. So you've got to put all your income expenses in together. Partnership does its own tax return, and then the profits are split according to the partnership interest. Joint ventures are probably what's more recommended if you're looking at that style structure. And then that's where you can set out what each party's obligations are. But each person is responsible for their own tax filing, and you don't get that joint and several liability under a joint venture. So
right. Okay.
Yeah, so they're probably the better structure than a partnership. If you're not looking towards the company or trust route.
Okay. So these would be alternatives to the company or the unit trust structures. Okay.
Yeah, well, joint ventures are fairly common if one party's already owns the land, and then they want to partner with the developer to realise the best value from that land. But the landowner doesn't necessarily have the skills, the ability, or the finance to do it. So that's quite often where we'll see joint ventures.
So just on that point, and there are many deals that obviously get done with a landowner. Without going into too much detail, if you've got a landowner that lives on the property, often they've lived there for 10, 20 years, whatever it might be, the questions do come up as to, will I be hit with CGT?
So but basically, if you're developing, subdividing the land, particularly if you cut off a block, build a house on it, or even just sell that vacant land, then yes, there likely will be some CGT applicable. So long as you meet the exemptions for the property being your home, the period that the whole property was your home is still exempt. So it's not fully subject to capital gains, but that does need to be assessed. What the tax implications are of developing that site, splitting it out. Okay,
so effectively, the ATO will say, well, from this time to this particular trigger, I'm assuming there's a specific trigger that then converts it into like a partnership, and it's become I don't know, there's a special word to it. You'll probably know better than I do, but it's like it's a commercial venture.
Yeah, so you've moved it from your personal home to an investment asset.
Yeah.
And that's when you need to consider the tax.
Okay.
That applies to that.
Okay.
And not just your income taxes or your capital gains tax, but also your GST implications as well.
Mhm.
Because even if you're just a individual doing a single property project, that can potentially have GST implications, depending on what your plans are, how much you sell it for.
Okay. All right. Let's see if we've got time to go back to that, because I'm sure we could probably go on for 5 hours. We've got a few questions here. So Namit, this one's a troublemaker. What are the risks of self-managed super investing in property developments?
Yep. So one of the big risks in super is liquidity if you're putting it into property. So property is typically a large asset, takes a lot of your cash. So unless you have a lot of cash in your fund, it can be difficult to have that liquidity. You need to ensure that the property isn't secured against any other lending, with the exception of a very restrictive borrowing arrangement that you can set up. There are structures where you can invest in super, and so long as you don't own more than 50% in that investment, you can partner with other people and do it and obtain some borrowing to get that gearing leverage that allows you to buy property if you don't have the cash available.
That would be an interesting one.
Yes.
Speak to Yoda about that.
Super is a minefield. On top of that, you need to have the property valued every 3 years at the moment, because your super fund needs to report at market value. And if it's a residential property, then your family are not able to use that property at all.
Right. Okay. So are you able to use it as sort of a holiday rental?
You can use it as a holiday rental so long as you and your family don't stay in it at all. Even if you pay market value rent for it, you're still not allowed to use the super fund assets for personal use.
Okay.
Very restrictive.
Right. So you got to make sure you are good friends with your cousin who will rent your holiday rental. This is not tax advice. No, not at all.
Not even your cousin.
Not even your cousin. Sorry, Justin says not your cousin. Lots of questions coming through. Excellent. People are warming up. Here we go. Halfway in. Peter, is there a limit to how many people that can be involved in a JV?
More of a legal question, but not that I'm aware of. But the more people you have, the more complex it gets, because everyone's going to have their different goals and ideas, what they want to achieve from the project. So in that scenario, it's very important to get everybody in the room, work out exactly what it is that they want to achieve, and also what everyone's roles and responsibilities are. So typically in a joint venture, you're doing it because you have complementary skills. Someone might have the land, someone might have the development skills, someone might have the builder. So you're all coming together to maximise the value that you can get from the project. If you're looking for a widely held investment where you're more just having people come in and put money in, you'd probably be more likely to look at either a company or a unit trust style structure, where the parties have less say and less obligations in the overall project. They can just put their money in, leave the responsible people to manage it, do the development, realise the profits and pay them out to the investors.
Yeah, I think that point about roles and responsibilities is quite critical, particularly when you're going into a JV. And I've seen situations where say, for example, a developer might be selling a property and they're open to JVs. And that's always a bit of a sort of a red light for me, because it's, if you've got two developers on both sides doing a JV, then who's really responsible for what?
Yep.
So like you said, be clear on who's doing what, and everyone knows their role. Yes. Oh, the questions are rolling in. we've got another, this is probably a comment. Khalid, CGT would not be payable. So this must have been in relation to the joint venture with a landowner. It would be taxed at your marginal rate, as this is a venture, not a capital gains event.
It does come down to that develop or sell or develop and hold consideration as well.
Mm-hmm.
So, yeah, while most joint ventures, yes, you do go in with the plan to build, sell, which is just get normal tax at your normal rates. But we have seen joint ventures where their plans were to build the property together, and then both parties, receive a rental return from that property. And so in that case, it can be taxed as a capital gain.
As income on your marginal rate. Is that what you meant?
If you're developing to sell,
yes,
then yes, income. And if it's in your personal name, tax at your marginal rate.
Mm-hmm.
But if you're going into a joint venture to develop a rental property that you're going to hold for long-term rental, then that can still be taxed as a capital gain.
Okay. All right. Now I'm clear on that. Okay, that's good. Another JV question. We've got 2 more JV questions, and then we might move along from there because everyone's keen on JVs. We must like people. If you have a few people in a JV as developers and they would like to JV also with an owner of a particular block to do a development as one-off, is it cleaner to have the initial JV partners in a company, or would it be okay to have a JV with 3 or more people and then add the owner of a block as the additional JV partner?
Yeah.
Good question.
Yes. Yeah. So what we would normally like to see in the ideal JV is if you do have that individual who's owning the land and you're looking to develop it, we would like to see the development done in either a company or a trust with the company trustee. And so that gets the development activities out of individuals' personal names, and that reduces the risks to the individuals if anything unforeseen did go wrong with the project down the track. So definitely ideal to have that company involved to give you that personal protection.
Yeah, okay, which sort of segues into Matt's question as well about JVs. If you're intending on entering into a JV, is it preferable to enter into that JV using either your individual name, trust structure, or company as your JV entity, which is, I believe, what we discussed.
Yeah. So that does really come down to your strategic goals on what you want to achieve for the project, and the specific requirements of the company or the trust in particular. Companies have a little bit more longevity. They retain their profits, whereas trusts are more of a flow-through entity. So typically individuals, but you can have companies as beneficiaries of trusts to get the benefit of the lower company rates. But ideally, you wouldn't be doing the JV development in an individual name, just because, again, that exposes you personally for the risks of that development.
Okay, cool. All righty. So I think we've got JVs down pat. And someone's offering JVs in commercial warehouse construction in Melbourne. Thank you. Maybe maybe later. So I'd like to talk a little bit more about the tax issues or tax topics that you see in property development industry. What are the issues that come up often? Yep.
So quite often at the moment, we're seeing a lot of audit activity from the tax office.
Okay.
In particular, the GST audits. So when you're developing a project, if you're registered for GST, you'll be spending a lot of money on the building, and quite often you're not getting any income at that stage. So you're getting quite large GST refunds usually. So pretty much every major development we've seen, at least one of the UBASs is going to get audited at some stage. So if you're not prepared for that, if you don't have your documentation ready, then that can end up costing you, particularly cash flow wise, and your GST refunds held up, delayed. So if you can respond quickly to that, tax office and say, yes, you're doing the right thing, and they'll release the funds a lot quicker. The tax office also get access to all the property sales information now, and so they've got a lot more visibility over property transactions. And what we're often seeing, particularly in large-scale developments, the tax office knocking on your door even before you've lodged your return, saying, how do you intend to treat this sale? Just a couple of years ago, we were working with a large developer, and they've held a fairly valuable block of land since before 1985. And for those that don't know, that's a magic date where if you sell it on capital gains, 0% tax, tax payable. But the tax office actually came and met with us, and they were basically trying to say, at some point in time, you've converted this to a property development, so we want to share the tax. But we were quickly able to articulate to them, show them that no, it's definitely held on capital. And they got that sale tax free. So that was potentially 7-figure saving for the client there. By being on the front foot and really knowing our stuff when dealing with the tax office.
Yeah, that's great, and particularly where you're dealing with assets that are pre-CGT.
Yes.
In particular. Okay, so
not too worried about the ones where you develop and sell and return a profit. It's more the ones that you try and say are capital gains, or if you're actually saying you're a developer and you've made a loss. We have seen a few of those, unfortunately, particularly around 2009 with the GFC, and potentially with the current economic situation. There may be some more in the near future if people aren't careful.
Shh, don't say that. It's a property development page. Everything's fine. There's no virus going around. Not at all.
No, exactly.
We just all like wearing masks. Okay, excellent. So on that point with GST, let's have a little bit of a chat about that. When should you be considering GST, and why? And in what situation do you need to adjust, consider GST, particularly in your feasibilities?
Yep. So basically, whenever you are commencing on any property activity that has that development stage to it, so basically if you're building, doing major renovations, if you've got commercial property, then really you should be considering GST. Your GST is sort of 10% of the sale value if you don't structure it correctly. But there are some concessions around property that can reduce the amount of GST you pay. So it is important that you're aware of what your GST obligations are, and particularly if you're building new property, chances are it's going to be subject to GST. So you will need to factor that into your cash flow. And one of the recent developments over the last few years has been the GST withholding regime. So previously, if you sold a property, you'd get all the sale proceeds, including the GST. Now, if you're selling a residential property, a deemed rate of GST is required to be paid direct to the tax office, so you don't see that money. Often that GST that they withhold is higher than your actual obligation. So that can have a cash flow impact for the developer.
Yeah, right.
So that's where good record keeping, so you can quickly lodge your BAS and get that GST refund if you've overpaid a lot quicker. And another strategy we look at for developers is lodging monthly BASs. Quite often you can lodge quarterly, but if you're building a property, spending money, if you're lodging monthly, then you can get those GST refunds a lot quicker into your bank account.
Okay, so if you're going through a DA process when you're just waiting and all of that, it's a good idea to look at it from a monthly perspective.
Yeah, that's right. Because all that money that you're expending, if those costs have GST on them, you can be claiming back that GST while you're waiting for the approvals. And then when the development ramps up, you're getting the GST back on your development costs.
Great.
Cash flow, helping minimise your interest if you've got borrowing on that.
And definitely help with the cash flow. Yeah, that's what Sasha said. We do our best monthly to help with cash flow. So particularly with development, cash flow is king.
Cash flow is king. Yes.
I'm going to have a quick sip of water here. Give me a sec. Excuse me. So it sounds like the ATO is starting to sort of do a bit of a crackdown on auditing.
Yes. Yeah, they are. And even for individuals, if they're just doing a little project by themselves, we'll see the tax office say they can see, then you might have bought a block of land for $300,000, sold it for $1 million. So they'll say you've made $700,000 profit, but they're neglecting the fact that you might have spent $500,000 actually putting a building on that property, which is why it's increased in value.
Yeah. Okay.
So that's where your personal record keeping is very important, to make sure that you can go back to them and say, no, these are all my costs. This is how it worked out, the profit that I've declared, and you can handle that in a timely manner. So
going back to the JV, if you're doing a JV with someone, make sure one of you is OCD and very good with your record keeping and administration.
Yes.
Excellent.
Yes, definitely. Either that or you've got good systems in place. There's some fantastic tax keeping apps around these days. You can use your phone, take a picture.
Yes.
So you don't have a lot of receipts that you need to keep. If you go down to Bunnings, get a few things for the project, take a picture of that, upload it. Your accountant gets it. You get the copy stored, and then if the tax office asks how you worked it out, you've got your documentation there.
Okay, good. So I want to go back to, in terms of even at the start of a project and actually involving your tax accountant in the feasibility side of things.
Yep.
I don't know how many people actually do involve you, but what are the things that you do get involved in?
Yeah, so the first part is around really talking to the clients about what their objectives are, what strategically what they want to achieve from the project, and that helps us actually set up and document what their plans are, so that if the tax office do come knocking on your door, the client can say, this is the advice that I've received from my tax accountant, and this is why we have chosen to report it for tax purposes this way. But we can also help with estimating what your tax amount is going to be, so that you can put that into your project costing, so that you're not hit with a massive unexpected tax bill at the end of the project. And also we can help talk about what holding costs are, whether you'll be able to, what expenses you can claim as deductions during the life of the project, which ones you can only claim when you eventually sell, and all those things can help with timing for your cash flow, particularly if you've got sources of other income. Now, if you've got costs that can be claimed immediately during the life of the project, that can help receive the benefits of those tax deductions a lot sooner if you've got other income that you can offset against them.
Brilliant.
So really strategic structuring can help maximise the benefits, and use the tax system to your advantage.
Yeah. So it really sounds like we shouldn't be giving the tax accountant the role as an afterthought, but really right at the beginning. As Sasha does say, my tax accountant checks all our fees before we go into a project. I think there's some really good takeaways there in terms of, if you're not doing your best on a monthly basis, probably have a look at doing that. And is it something that's easy to switch to if you're doing quarterly best already?
Yeah.
To switch to.
you need to switch at the end of a quarter.
Okay.
So that's your September, December, March, June. But yeah, if you want to talk to the tax office, you can wait on hold and they can switch it over for you, or your tax accountant can arrange that with our online systems that we've got. But bear in mind, you will have that regular reporting obligation. If you don't lodge your bath on time, every month you can be fined over $1,000 for late lodgement. So very important that you have those record keeping systems under control, so that when the end of the month rolls over, you can quickly log into your system, lodge your BAS, get your refunds done.
Okay, right. Log in your BAS.
Yes.
And what are we? March. All right. So got another month to the end of the quarter. Have a think about what you need to do in terms of making any adjustments. We've hit about 45 minutes in, so I'm going to hand over to the floor to see if there are any questions. But while we're waiting for questions to pop up, and I'm sure there'll be a few, did you have anything in particular that has come to mind in terms of what property developers should be keeping an eye out for that we haven't discussed?
So we've seen some of the natural disasters over the last few months, particularly around the bushfires. So there are some tax concessions around for deferred lodgements and payments. Okay. So if you are impacted by those,
right,
it's worthwhile getting onto the tax office, finding out what concessions you've got.
Very good.
If you're up in Queensland and you have a business that's subject to payroll tax, the smaller employers have a 6-month opportunity to defer their payroll tax at the moment if their business has been impacted by the coronavirus. So, keep an eye out. I haven't seen any announcements from the other states. But there's going to be a few concessions around over the next few months. So keep an eye for those and take advantage if they apply to your circumstances.
Didn't realise that must be a first, because I haven't heard it in New South Wales as yet.
No, we had a look because we do have clients that operate in both New South Wales and Victoria.
Okay.
But we haven't seen any announcements from them at this stage.
Interesting. I've got a question, and this always sort of stumps me, and about the margin scheme.
Yes.
When you need to apply the margin scheme to your purchase, talk us through, without going into too much detail, what are the considerations there?
Yeah. So the first one is working out whether you're eligible to use the margin scheme.
Okay.
And generally you can do that if you acquire a property where you don't pay GST on the acquisition. So if you purchase it from an individual who's might have been their home, they're not going to be registered for GST. And so then if you do a development on that property that's subject to GST, then chances are you'll be eligible to use the margin scheme. And basically, in a normal commercial GST transaction, it's only the final consumer that pays the GST, and all of your costs along the way, you get to claim all the GST back. So the margin scheme is designed so that if you as a developer buy a property that doesn't have GST on it, when you eventually sell that property that is subject to GST, you'll only pay GST on the difference between the sale price and the land purchase price. So it's a concession. It's a lower rate of GST that you pay, and it effectively gives you the benefit of a GST credit for the land acquisition, even though there was no GST on that.
Yeah.
When you bought it.
So on that, it's a question I guess every developer should ask, if when they're purchasing a property, more likely than not, if it's been owned by someone for 20, 30 years, more than likely no GST, but anything that potentially could have had some sort of commercial use, or been owned by a developer?
If it's commercial or already owned by a developer, there could already be GST on the purchase. And in that case, the margin scheme won't apply when you go to sell. So it's more if you are purchasing from the mum and dad. They might have had a large suburban block for the last 20, 30 years, finally downsizing. It's got good ability to either knock down, split up. If you're in a developer, and then the new properties that you build likely to have GST on them. But you can deduct the value of that original land purchase that you paid against your sale price. So you only pay GST on the difference, whereas normally you have to pay GST on the full sale price.
Yeah, excellent. Okay, so get some advice around that.
Yes, and particularly before you sign the sale contract, because there are some, the GST clauses in the contract need to be completed basically at the time of signing the sale contract. So it's important to get that documentation right so that you are eligible to use the margin scheme. Because the worst case scenario is you pay or you lose 1/11 of your sale price in tax. Yeah.
And looking at the average house prices around Australia now, 1/11 of your sale price is a fair chunk.
It's a lot of money. Yes.
Yeah. Great. Justin, that has been fantastic. I can't see any questions except Sasha being excited that flights are cheap. Flights are cheap and flights are fairly empty as well.
Good time to travel.
Good or not so good time to travel. But I think we covered a lot of ground in that short time. So I'm sure there'll be certain questions that pop up on the comment section. Really important, I like for people. So I forgot to mention that Justin is based out in Queensland.
Yes.
In Brisbane, Vegas.
Yes.
I will put up your link as to how people can get in contact with you if they're looking for, if you know anyone who's a trusty tax accountant and familiar with property development, maybe you can point them in the right direction. But Gil McCarroll's website, I believe there's a contact us link, which if you can share with me, I'll pop that into the comments as well when we're finished. So I think that's been fantastic, Justin. It definitely has brought up quite a lot of questions around the structuring, obviously, JVs, my big question around margin scheme, because it always really does my head in. But I think that's great that we've covered so much ground in that time. So we'll get your details up. If anyone is looking, particularly have someone who understands property development, I think it's absolutely critical. And if you have the Yoda here, who is so cool under pressure, he's still smiling as well. So he must really like what he's doing. Thanks, Justin. It's great having you. And if anyone has any questions, pop them in the comments. And Justin, do head on to the Property Development Australia page as well and scroll through any comments there, and feel free to obviously respond to them as well.
Yep, definitely. I'll have a look at that. And thanks to Cheryl for the opportunity.
Thank you for your time. Thanks everyone for tuning in, and feel free to keep continuing with any sort of comments and questions. All right, Justin, have a good night. We'll see you later.
Thanks, Cheryl.
Bye-bye.